Florida's housing market is about to break. Not years from now, not sometime in the distant future, but in 2026. All the hidden costs, new rules, and financial risks are set to collide, and the impact could be bigger than anyone expects. For years, the market looked unstoppable. Migration, low interest rates, and investors convinced Florida was the safest bet in America. But the numbers have flipped. This isn't shaping up to be a gentle correction. It's a perfect storm of sky-high insurance premiums, mandatory condo reserves, cooling migration, and mortgages that reset at the worst possible moment. In this video, I'll show you why Florida is uniquely vulnerable, the red flags already flashing, and how this storm could wipe out billions in home equity. For the first time in over a decade, Florida is drowning in supply. Listings have climbed to levels not seen since 2012, a clear sign that demand is breaking down. Not long ago, homes practically sold themselves. A weekend on the market often meant multiple bids, sometimes over asking. Those days are gone. Now sellers wait weeks, sometimes months, just to get a showing. Price cuts are everywhere. Redfin data shows record-high inventory, and Zillow confirms something bigger. Statewide prices slipped in 2025. That's the first broad decline since the pandemic boom, and it signals that momentum has flipped. And here's why it matters. Every extra month, a listing sits unsold, puts pressure on sellers to adjust. In real estate, those adjustments almost always go one way: down. Combine rising supply with fewer buyers, and you don't get a soft cooling. You get the first domino in a real correction. If rising inventory is the first domino, insurance is the hammer that knocks it over. In Florida, insurance isn't just another monthly bill. It's often the difference between keeping a home and being forced to sell one. In recent years, big-name insurers have pulled back. Some stopped writing new policies altogether, others walked away from entire regions. Many homeowners who lost coverage had no choice but to turn to Citizens, the state-backed insurer of last resort. On paper, Citizens' policy count dropped in 2024 and 2025 as private companies took some policies back. But here's the truth. Premiums are still sky-high, deductibles are higher, and coverage is weaker than before. The crisis hasn't ended. It's just changed shape. Run the math. A $2,200 mortgage plus $700 or $800 in monthly insurance is a 30% jump in housing costs. For many buyers, that's a deal breaker. And without buyers, sellers get stuck. Even inland condos and townhomes aren't immune. Premiums now factor in aging infrastructure and soaring replacement costs, not just hurricane risk. And unlike your bank, your insurer can cancel coverage with a single letter, creating fear, instability, and forced sales across the market. In short, insurance has become Florida's second mortgage, and it's one that only gets more expensive over time. If insurance is Florida's second mortgage, condo laws are the hidden bill no one planned for. After the Surfside tragedy in 2021, lawmakers passed strict new rules. Every large condo must undergo milestone inspections and set aside fully funded reserves for major repairs. For decades, many condo boards kept fees low by skipping reserves, patching problems, or using one-time assessments. That era is over. The new Structural Integrity Reserve study forces boards to calculate exactly what's needed, and then collect it every year. The deadline for these studies was pushed back to December 31st, 2025. But that only delays the pain. Starting in 2026, owners will see massive fee hikes or lump sum bills, sometimes reaching 6 figures per unit. Retirees on fixed incomes aren't ready for that. Some are already panic listing, while buyers hesitate, afraid they'll inherit an assessment nightmare. It's a squeeze from both sides. Sellers trying to exit, buyers holding back. And remember, this doesn't hit in isolation. It lands right alongside high insurance premiums and slowing demand. That's why 2026 isn't just a deadline. It's a market mover. Buying a home in Florida also means buying exposure to some of the most expensive weather in America: hurricanes, flooding, and rising sea levels. And insurers are already pricing that risk in. Premiums have jumped faster here than almost anywhere else in the country. And the scary part? Rates have climbed even in quiet hurricane seasons. Why? Because the math has changed. Risk models now assume higher odds of catastrophic hits, and insurers are charging ahead of time. The cycle is brutal. Each storm season brings more anxiety, higher premiums, and stricter underwriting. Some regions, like the Gulf Coast and the Keys, are already considered uninsurable by private carriers. That leaves homeowners scrambling for costly state-backed coverage. And those costs don't go away when storm season ends. They stick. Every new buyer must now budget for a mortgage and an insurance bill that can rival a car payment, or even another mortgage. This is how climate risk turns into market risk. It slows buyers, pushes owners out, and amplifies every other pressure in the system. Combine that with soaring inventory and looming condo assessments, and you don't just get a cooling, you get cracks in the foundation. Florida's housing boom was also built on migration. For years, it seemed like everyone from New York, New Jersey, and California was packing a U-Haul and heading south. Remote work made it easier. No state income tax made it cheaper, and the sunshine sealed the deal. But that wave has slowed. Florida is still gaining people, but at a much weaker pace than during the pandemic peak. At the same time, out-migration is climbing. Families are leaving because they can't keep up with rising insurance, HOA fees, and looming condo assessments. Many are heading to Texas or the Carolinas, where the cost of living is lower and job growth is just as strong. This matters because migration wasn't a side factor. It was the fuel that kept demand red hot. Without it, the market loses constant pressure. Prices don't stay flat, they fall. And the profile of newcomers has changed. Instead of wealthy buyers snapping up homes at any price, many new arrivals are middle-class families stretched thin. That means smaller down payments, less bidding power, and more sensitivity to costs. In short, the inflow that once drove the boom is no longer enough to counter the outflow. And just as that wave breaks, another financial shock is waiting in 2026. Adjustable rate mortgages resetting all at once. When prices peaked in 2021 and 2022, many buyers stretched thin to get into Florida real estate. To make it work, a surprising number turned to adjustable rate mortgages, ARMS. The idea was simple: lower initial payments, 5 years locked in, and the hope that rates would fall or values would keep climbing. But here's the problem. Those 5/6 ARMs reset right in the middle of 2026. For thousands of households, that means sudden payment jumps, sometimes $1,000 or more per month. Now layer that on top of already inflated insurance premiums and new condo reserve fees. The budget squeeze becomes impossible for many families. Even though ARMS aren't the majority, they don't need to be. A wave of owners facing higher payments at the same time can trigger forced sales, and that extra supply hits just as demand is cooling. This is the affordability crunch in action. It's not just high prices, it's the rising carrying costs that pile up long after purchase. When owners can't keep up, they sell. When buyers can't afford to step in, prices fall faster. Up to now, we've looked at each pressure point in isolation: inventory, insurance, condo laws, climate risk, and ARM resets. On their own, each could cause serious stress. But the real danger is timing. In 2026, they all collide. By the end of 2025, condo boards will have completed their mandatory reserve studies. In 2026, those turn into bills. Massive monthly increases and special assessments hitting thousands of owners at once. At the same time, insurance renewals remain among the highest in the nation. And for those who bought with ARMs in 2021 to 2022, the first big resets arrive mid-year, Stack them together, and you get a market where more owners have to sell, while fewer buyers can afford to step in. That's the setup for panic selling. And when sellers panic, prices don't fall gradually, they fall all at once. Housing markets don't crash because of one headline. They crash when multiple costs and deadlines pile up until the system breaks. Floridas aren't hidden anymore, they're on the calendar. And that makes this downturn possible to anticipate. That's why analysts call 2026 the pivot year. It's not speculation, it's baked into the system. Unless something changes fast, Florida's housing market won't just cool. It could reset in a way that few are prepared for. So where does that leave us? Florida's housing market isn't heading for a gentle slowdown. It's facing a rare collision of deadlines and costs that all come due in 2026. Rising inventory, high insurance premiums, mandatory condo reserves, climate risk, and mortgage resets. Alone, each might be manageable. Together, they create conditions the market hasn't faced in over a decade. For homeowners, that means the window to sell before pressure builds may be narrowing. For buyers, patience could prove powerful, because the best opportunities often appear when uncertainty is highest. And for investors, some are already repositioning, preparing for the chance to step in if values reset. This isn't about predicting the future with certainty. No one knows exactly how severe the impact will be. What we do know is that the pressures are real, the deadlines are fixed, and the risks are rising. Florida's market may not collapse overnight. But when multiple dominoes line up this closely, even a small push can set them in motion. The real question isn't whether the storm hits at full force. It's whether you'll be ready if it does. And if you want to stay ahead of what's really happening in housing and finance, not just the headlines, make sure to subscribe. That way, you'll be the first to know when the next big shift is already underway.